Hi, Professor Rex here. In this week's video, I'm going to focus on the two dividend stock portfolios in yellow in which we invest additional money on the first trading day of every week. They are the Dividend-Growth portfolio, which was started in 2022 and now has an annual return of 16.06%, and our high-yield stock portfolio, which surprisingly has a higher return of 27.01% per year. The high-yield portfolio was started in 2023. In next week's video, we'll talk in depth about our newest portfolio, the tech stock portfolio that my accounting students and I started last year as outlined in red, and now has an annualized return of 6.76%. It's our newest portfolio, and because it's 100% invested in tech stocks, it's our most volatile portfolio. Like our dividend stock portfolios, a tech stock portfolio is a real-world investment portfolio where I make additional investments on the first trading day of each week. So in effect, all three portfolios are accumulation portfolios, mimicking someone in their working years who is consistently adding to their investment portfolios. As a reminder, the portfolios on the right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. So you can go online at beatthestockmarket.com to read more about them if you like less frequent trading. First, we'll do a quick performance overview. Our best performing portfolio so far is surprisingly our high yield stock portfolio, which now has an annual return of 27.01%, and it's handily beating the S&P 500 since the portfolio started. And our dividend-growth stock portfolio, the original portfolio that we started, now has an annual return of 16.06%. The chart on this slide shows the growth of our dividend-growth stock portfolio. And our tech stock portfolio is our most volatile portfolio since it's 100% invested in tech stocks and is the portfolio we started most recently. Its annualized return has dropped to 6.76%. Because it's our newest portfolio, its performance jumps around a lot more than our other portfolios. Since our last video, tech stocks have continued to get hammered, and tech stocks are now in a correction. A correction means the stocks have fallen 10% or more. A bear market is when the stocks fall 20% or more. We're not in a bear market yet. More on that on the next slide. And later in the video, I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. But depending on how much diversification you require, that might be relatively easy to do, as our dividend-growth stock portfolio currently has 104 holdings. Our high-yield stock portfolio has 36 holdings, and our tech stock portfolio has 26 holdings. So what's this slide showing? It's showing the portfolio value over time of our original portfolio, which invests almost exclusively in dividend-growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,807 after 166 weeks. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks. So we're buying fractional shares of stock. Each week, we re-rate the stocks, so the list of top stocks fluctuates from week to week. And in August of 2023, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Now, the tan line on the chart shows what the portfolio value would be if we'd instead put the money into a savings account. In our first year, 2022, stocks and bonds did very poorly. And as you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023 and 2024. I'll update our tech stock portfolio in next week's video, which we started late April of 2024, and was the best performing portfolio until the last 2 or 3 weeks when tech stocks started getting hammered as people rotate out of momentum and high growth stocks, which is often tech stocks. And for those who have been asking, all three of the portfolios are now on our website, which is beatthestockmarket.com. We post the stocks that we're buying in real time on the first trading day of the week, which is usually Mondays, unless there's a holiday, because that's when we make our investments. And anytime we sell a stock, we also inform our subscribers. And we also post information about portfolio holdings and trade confirmations. Before we talk about our dividend portfolios in depth, let's look at what happened recently and what's coming up this week. Now, the S&P 500 had its worst week since September of last year due to the on-again and off-again nature of the tariff announcements. Since their recent highs, the S&P 500 has fallen 6.1%. Tech stocks have fallen 10.1%, meaning they are technically now in a correction. and dividend-paying stocks, as measured by the ETF with the ticker symbol SCHD, have fallen 4.3%. Studies show that dividend-paying stocks outperform non-dividend-paying stocks, especially in down markets. Our two dividend stock portfolios have fallen about half the amount of the S&P 500, with our high-yield portfolio doing the better of the two, since it has much less allocated to the technology sector. According to the Center for Financial Research and Analysis, the Trump administration's indecision on tariffs this week, levied on Canada and Mexico, unsettled markets, meaning the stock markets, after President Donald Trump suspended 25% tariffs on goods covered by an existing free trade agreement until April 2nd. One thing Wall Street does not like is uncertainty. If it turns out the tariffs are just a negotiating ploy and are not permanent, the stocks will likely get back on track very quickly. And we could have a repeat of a good year like we did in 2023 and 2024. However, Morgan Stanley thinks the tariffs may be around for a while. Morgan Stanley revised their forecast for U.S. economic growth lower for 2025 and 2026, saying facts have changed. We now see higher inflation in 2025 with a more pronounced and sooner reacceleration in goods prices, unquote. And speaking of inflation, next week we've got two inflation reports. We've got the CPI report on Wednesday, and we got the Producer Price Index report on Thursday. If both come in lower than expected, there will be a lot of conjecture that the Fed might cut interest rates again, which would greatly benefit the stock market and the economy. Now, I don't try to time the market, meaning I don't try to sell all my stocks and get in and out of the market. But if I were to guess, I would say we don't get any more rate cuts this year. But if we do, I will gladly take them. Before we get into the stocks we bought last week, a lot of people have been asking me for my favorite books about investing so they can try to replicate some of the things I do. My two favorite books were the basis for the 3 stock screens I publish monthly on our website, which you can see on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, and I started rereading it recently. So the author's investment firm managed over $6.4 billion of investments when he retired. The book is the basis of 2 of the 3 stock screens I publish on our website, beatthestockmarket.com. They are the Trending Value stock screen and Consumer Staples stock screens. I update the stock screens monthly, but you can get the book and do it yourself. So what is a stock screen? It is a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do further analysis of them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the PE ratio, which stands for price to earnings, dividend yield, etc., as well as combinations of those simple metrics. There are a lot of tables and graphs in the book, so if you're a numbers geek like me, you'll probably like the book. It also talks about the history of the stock market and the psychology of investing, which is also fascinating. Now, before you buy it, I recommend checking your local library to see if they have that, because your taxes are paying for your local library. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own. It's a much shorter book than What Works on Wall Street. I'll try to put links to the 2 books in the description of the video. Because we're investing additional funds each week into most of our model portfolios, the way we calculate portfolio performance becomes more complicated. The formula that is most commonly used to calculate portfolio performance is called XIRR, or Extended Internal Rate of Return, and we use this formula too. It's the same formula used to calculate portfolio performance in Quicken, which is the personal finance software, the most popular personal finance software. You can see the formula at the bottom of the screen. You can calculate it by hand, but if you want to maintain your sanity, you're better off using Excel to calculate it for you, and then use Quicken to double check it, which is what we do. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed, because remember, they were started at different times. The high yield portfolio was started in August of 2023, and the annualized return so far is 27.01%, which is surprisingly higher than our dividend growth stock portfolio, which has an annualized return of 15.64% over the same time period. I expect that the dividend growth portfolio will have the higher return over the long run, especially since the high yield portfolio has less than 1% of the portfolio in tech stocks. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. On our website, we have ideas for technology-focused investments that provide income, ranging from dividend growth stocks like Microsoft and Broadcom to closed-end funds and ETFs. Now, one reason the high yield portfolio is beating our dividend growth portfolio over the same time period might be the very fact that the high yield portfolio has very little allocated to the technology sector, which has not done well lately. I think in the long run, it will definitely bounce back. Remember, the high yield portfolio has only existed for 19 months, so its annual return will likely jump up or down to a greater extent than our dividend growth portfolio's return. And for that matter, a tech stock portfolio has an even shorter history, which is why its performance has varied the most. Now, a very popular exchange-traded fund called an ETF that only holds dividend stocks is the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. Now, SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our two dividend-paying stock portfolios. As of today, our dividend growth stock portfolio's annual return is 16.06%. If we'd instead invested the same exact amounts of money into SCHD on the same exact days, the portfolio's return would only be 10.36%, a difference of 55%. Our high yield portfolio is also outperforming SCHD, but by an even larger amount. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our two dividend-paying classroom stock portfolios. This slide shows our best performing stocks for our original portfolio, which is the dividend growth stock portfolio, based on when they were initially purchased. Now, the stocks in yellow have been sold. Our best performing stock so far had been Broadcom, but with a sell-off in tech stocks, it's now in second place with a 251% gain in less than 3 years. Broadcom's stock did jump 8.64% on last Friday after it released its latest quarterly results, which were obviously pretty good for it to jump 8.64%. Evercore, an investment bank, is in first place with a 252.9% total return. It's in yellow, like we said, which means it has been sold. The fastest risers that are still in the portfolio are Bank of New York Mellon, which has more than doubled in 17 months, and good old boring WK Kellogg, which is up over 80% in 16 months. And remember that total return includes both the dividends the company has paid as well as an increase in the stock price. Now let's look at this column called strategy, specifically the category called dividend growth stocks. 89% of our investments made in this portfolio were made in these stocks, which means they are high quality stocks with a great track record of increasing their dividend payouts to investors. The other 11% of investments so far have been invested in usually smaller, under the radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown that they historically beat the stock market averages by a significant amount. Here's a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. Now on to stocks we purchased this week. So as we said before, 89% of our portfolio is comprised of high-quality dividend growth stocks, meaning they're high quality and they tend to increase their dividends. But the other 11% or so have been invested in under-the-radar dividend payers. So an under-the-radar dividend payer is a company that has recently started paying a dividend, is not yet well known for being a dividend stock. Now, last Monday, we added to two under-the-radar dividend payers, Meta and Nvidia. Meta started paying their very first dividends relatively recently and appears to be undervalued and is in the communication sector. Our dividend growth portfolio is underweight the communication sector when compared to the S&P 500. And I want to boost our allocation to that sector, so I've been buying Meta lately. I should say I've been adding to our Meta holdings lately. We also made an additional investment in Nvidia after the stock's price pulled back due to the DeepSeek announcement. Nvidia definitely does not pay a large dividend yield, nor does it grow its dividend at a high rate, but with its high profit margins and high levels of cash flow, it could definitely become a strong dividend grower in the future. Now on to the usual, but before we get to those 10 stocks we bought. Let's talk about companies initiating dividends. If you want to do your own research on companies that have recently initiated a dividend, here's a good place to start. These companies have all recently announced they will start paying a dividend. Studies have shown that companies that either start a dividend or raise their current dividend significantly outperform stocks that do not pay a dividend. Now, many of these are very small companies and therefore have greater risk and greater upside potential. It'll be interesting to see which of these companies will become dividend growers in the future. Our biggest successes in this category of stocks, meaning under the radar dividend payers, have been F&G Annuities and Repositrack, both of which basically doubled in 12 months. We only held the stocks for about 12 months each, but we'll take a doubling in 12 months. Now, a new dividend initiator on this slide this week is called Ingram Micro Holding Corporation, which is in the volatile tech sector. So if you're good at analyzing smaller companies that don't have a lot of coverage, you could do really well in this arena. Now we can talk about the 10 dividend growth stocks we bought, in addition to those 2 under the radar dividend payers we bought, which were Meta and Nvidia. So I posted these rankings to our website, the top 15 dividend growth stocks as of last Monday. We purchased the first 10 stocks on the list that are not in yellow highlights. Well, there are no yellow highlights, but if the stock had comprised 4% of our portfolio or more, like Microsoft is really close to doing, then we don't buy more of that. But we can ignore that since none of them were at 4%. Now remember, we use many criteria to filter stocks, and if a stock is near a required level, a stock can make the list one week and then drop off the list based on a small movement in that metric on the next week. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. For consensus earnings growth estimates, I will only purchase a stock if its earnings, which means profits, are forecast to grow at least 5% over the next year. That's because we want to invest in stocks that can continue to increase their dividends. So a stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which means the stock suddenly does not make the list at all. This is just one of our many filtering criteria we use to narrow down a list of investable stocks. So once again, each week we buy 10 stocks. We buy the first 10 on this list. So from Taiwan Semiconductor down to MSCI, we bought those 10. And because we're investing a small amount each week, that means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week, when we're buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we're purchasing that week. Now, this table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates that they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage account to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stock portfolio in the next few slides. This week I purchased over $2,700 of the stocks from the dividend growth stock portfolio and the high yield portfolio as I reinvest dividends and gradually transfer out of my main dividend ETF, which is SCHD, as I mentioned before, and buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost the returns. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 89% of our purchases. The other 10% or 11% so far have been invested in smaller under-the-radar companies that have recently started paying a dividend. Those under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. Now, risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits, which a lot of companies try to fudge a little bit. And finally, the last quality component is financial health. Remember that the risk ratings are comparing these stocks to other stocks, not to other investments like bonds or CDs. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works usually. Companies that are already paying out a higher dividend yield rarely have the greatest potential for the greatest growth in those dividends. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we received once a stock split has occurred. And here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of the portfolio. This leads to a less risky, more diversified portfolio. So that means this weekend when I do the new ratings, if any of these top 4 stocks, which are all at 4% or more, if any of them are on my buy list, I will not buy them because they already have a significant portion of the portfolio. Now, it's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated and more volatile portfolio. And many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings now are at 104, with 89% of the weighting being in the high-quality dividend growers and 11% of the portfolio's weight being in the under-the-radar dividend payers. We usually make far more additional investments into the dividend growers than the under-the-radar dividend payers. So far, around 100 to 105 stocks seems to be the natural limit for the portfolio, as there are only so many quality dividend-paying companies that are trading at a discount. That might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information in the spreadsheet, which we do at least weekly and doesn't take that much time. The thing that did take a lot of time was creating the spreadsheet. It took 2 long years to create. Now let's look at our high-yield dividend-paying stock portfolio. I've had several older accounting students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. I didn't have super high hopes for the portfolio. I thought I was just going to pay really high dividends and have moderate growth. So far, it's been outperforming my expectations, that's for sure. The portfolio as a whole has an annual total return of 27.01%. Since the portfolio has been in existence for 19 months, that return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which was started 20 months earlier. Currently, the high yield portfolio's dividend yield, if you bought all the stocks today, would be 4.05%. Compared to our dividend growth stock portfolio, the companies in the portfolio likely will not grow their dividends as fast. Therefore, this portfolio would be more geared toward investors closer to retirement. Now, having said that, many stocks in the portfolio have increased their dividends, and we've been able to sell some stocks at a high price and reinvest into better bargains, pushing the portfolio's yield based on the amount we've invested to 4.94%. Now, 2 strategies are being implemented in this portfolio, as you'll see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, that being high yield and dividend growth. Not easy to do, but we're trying. Strategy 2 has been the better performer. The average investment in Strategy 2 has provided a total return of 18.22% and has been held for an average of 211 days so far, which is an annualized return of 33.6% using Excel's rate function. Now, it's not likely the portfolio can keep an annual return that high since stocks historically average 9 to 10% each year, but so far so good. Now let's talk about the high yield dividend paying stocks we bought last Monday. I posted these rankings to our website, pizzastockmarket.com, last Monday. Then we purchased the 8 stocks listed on this slide. And because the high yield portfolio currently has less than 1% in tech stocks, for those that want to add diversification to the portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft and Broadcom, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields don't have the chance to grow their distribution yields as fast as one like Microsoft or Broadcom. There's always a trade-off, and so don't chase high yields. Chasing high yield all the time can burn you in the long run. Now, one thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchased 8 stocks, and we have 2 different strategies within the portfolio. Strategy 1, as I mentioned before, emphasizes a high dividend yield over dividend growth. It's perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 dividend strategies, we have 4 stocks in Strategy 1 and 4 stocks in Strategy 2, giving us 2 rankings, and sometimes a stock will appear in each strategy. Both strategies only invest in high-quality stocks, meaning a high-quality rating of B- or better. The 4 high-yield stocks we bought last week while implementing Strategy 1 are Comcast, Glaxo, Target, and CME. And the 4 high-yield stocks we bought last week while implementing Strategy 2 are Comcast, PNC Financial, CME, and PepsiCo. Here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. Now, Glaxo pays a variable dividend, hence the less than stellar dividend growth rate. And in the last column, you can see their grades for dividend growth potential, which on average will be much lower than the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. On this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Once again, we had several dividend increases for our portfolio's stocks. American Tower hiked quarterly dividends by 4.93%. This real estate investment trust has managed to grow its annual dividends since it started paying dividends in 2011. General Dynamics raised quarterly dividends by 5.6%. This is the 28th consecutive annual dividend increase for this dividend aristocrat. If you're wondering what a dividend aristocrat is, I've got the definitions over here on the left side. American Express raised quarterly dividend by 17.1%. Domino's Pizza hiked its quarterly dividend by 15.2%. That's the 12th year of consecutive annual dividend increases for this dividend achiever. And Home Depot increased the quarterly dividend by 7.7%. This is the 16th consecutive annual dividend increase for this dividend achiever. So the last 22 dividend increases, and that's how many fits on the slide, for the portfolio have an average increase of 9.1%. This slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Dividends for the month of February increased 70.2% over the same month a year ago. This chart shows how quickly the dividends are growing in the portfolio and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our two main stock portfolios? The first reason is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion, that being that dividend-paying stocks have a higher return and less volatility than non-dividend paying stocks on average. That second point about having less volatility is probably even more important than the fact that dividend paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks is measured by beta and standard deviation, tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, on the right side of the slide, you can see that the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolios of dividend-paying stocks only invest in dividend-paying stocks that have increased their dividend recently. Along the same lines, BlackRock recently released a report showing that $10,000 invested in companies that increase their dividends, called Dividend-Growers, and companies that started paying their first dividend, called dividend initiators, grew to $2.6 million. That same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So investments made in stocks that raised their dividends or started paying a dividend grew more than double than if the stocks were instead made in stocks that did not pay dividends. 116.7% difference to be precise. So not only do dividend-paying stocks historically have a higher return on average than stocks that do not pay a dividend, and they have less volatility on average, they also perform better than non-dividend-paying stocks in down markets, also called bear markets, by 1 to 2% per month, not per year. This is very important because what causes investors to panic and sell at the worst time is when they see the value of their stocks plunge. But dividend-paying stocks hold up much better in down markets than non-dividend-paying stocks. This is from a report or a study in the Journal of Corporate Finance. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom, which just increased its dividend for the second time last year and for the 14th consecutive year. Now, I bought Broadcom, a chip maker, in 2020, just 5 years ago, for my taxable account. At the time, its yield was 5.01%, meaning that for every $100 I invested in the stock, I would receive $5.01 each year. The company has quickly grown the dividend to the point where the yield based on the original investment is now 9.14%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a diversified portfolio. That's the power of investing in quality dividend growth companies. My second example of a high-quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents a year. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield, based on my original investment, is now 31.81%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to the yields on the original investments that these two stocks are paying. And bonds do not increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. That's perfect for retirees. If you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in the previous year. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military before I got my degree, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck into the Dividend-Growth portfolio, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. Another reason I started with a low investment amount per week was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74 per week. For our classroom Dividend-Growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And for this year, the inflation was even lower, so we boosted the weekly investment by only 37 cents. So we now invest $14.18 on the first trading day of each week. Now let's talk about ways to potentially increase the return of our Dividend-Growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's returns. Each week we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5, or maybe like 1 through 6 or 1 through 7. However, the downside is this reduces portfolio diversification, but some investors are more comfortable with a more concentrated portfolio. So far, investing in only stocks ranked 1 through 5 would have improved annual returns by 45%. but I personally prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. Option number 2, you could try not limiting individual portfolio holdings to 4% of the portfolio's total value. So normally, if a stock's allocation in the portfolio is 4% or greater, I will not purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio does not become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified because the ultimate goal of dividend investing is to have the dividends cover all of your expenses, plus generate extra income for vacations, travel, etc. I'm a conservative investor and I'm personally investing a lot in these dividend portfolios. So I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's rankings, as mentioned in bullet point 1. So far, not limiting individual stock positions to 4% of the portfolio would have improved the annual returns by 55%. But again, I personally prefer a more diversified portfolio. Number 3, so the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities, 119% gain in 12 months, and Repositrax, 97% gain also in 12 months, on average, they've not performed quite as well as the dividend growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks have not done quite as well as the dividend growers is because many of those under-the-radar stocks are very small companies, and small stocks have not performed as well as big stocks in recent years. Like the previous strategies, this method reduces portfolio diversification. And number 4, you could try selling when a stock is fairly valued, even if the dividend and quality metrics are excellent. So we don't sell stocks often in the portfolio and tend to only sell if the company cuts the dividend or the stock appears to be overvalued or the company's dividend and quality metrics fall out of the top 50% of stocks. In other words, if a stock appears to be fairly valued, but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and it signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in that week's top 10 stocks that we're buying. The downside would be higher turnover, but this could boost your portfolio's returns by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this 4th strategy is the most difficult to implement because you have to have your own valuation methodology and then you also have to implement it on your own. And for those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For our model portfolios, we invest weekly, but there's no hard and set rule that says to do that. Now, most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually paid every other week, and it's automatically invested in their 401k. When I started our dividend-growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. Now, the advantage of investing every week, as opposed to every other week or monthly, is you get more diversification. So if one doesn't mind less diversification in their portfolio, option 1 is to invest every other week or monthly instead of weekly. Option 2 is to just buy the high-quality stocks, meaning those with a quality rating of B- or better, and hold forever. In other words, you would skip the under-the-radar dividend payers. Over time, some of those stocks will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. That's it for this week. In the comments, let me know if you have any questions, and also let me know what other portfolios or investment strategies you'd like to see more of. And finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, LinkedIn, and Twitter. I'll talk to you next week with another portfolio update. See ya!